Hi, Joe Lopresti here with the Arlington Wealth Management Proactive Investment Strategy Update for September 9th, 2022. Well, in today's update, I want to talk about how market and economic conditions are evolving rapidly. Since our last update, one of our critical recession models moved into recession alert territory with the monthly data updated for July now that all that data is in. That change, in our view, increases the probability of something more than just a minor recession in the months ahead. With that change in our models, we've taken some additional precautionary measures to preserve wealth. Our investment strategy has been more active this year than in a typical year. And the reason is that the models we use to drive our decisions that help us remain unemotional have been unusually active. We design our investment strategy and approach to be flexible and dynamic to adapt to conditions as needed. So in today's update, I want to review the various models that we use and discuss how they interplay with one another. So the first is our proprietary market model. That carries the highest weighting in our decisions. It's the one we discuss nearly every week on these strategy updates, and it's displayed on our dashboard. We designed it to help us identify the primary market cycle and potential turning points in the market. The objective is to position your account for wealth accumulation when the model's positive and wealth preservation when the model's negative. Pretty simple. The vast majority of the time, the model's positive. In fact, only about 15% of the time is the model negative, so it's rare, but when that happens, we really want to focus on preserving your wealth. The market model gave us numerous warnings that the previous bull cycle was potentially topping out and then rolling over. For example, there were tactical sell signals last year when stock prices reached unsustainable levels. Then in January this year, our 210-day warning indicator flashed a sell warning. Those signals helped us pare back your exposure to the market and reduce risk. And then the global sell signal triggered in April, and that's when we moved to maximum defense to eliminate your risk from a potential bear market. In July, the model began to indicate risk levels were getting restored to set up a reasonable time to invest some cash back into the market, and a tactical buy signal occurred. A tactical buy is really the opposite of the tactical sell that occurred last year. It meant that the bear market that we were in had likely reached an unsustainable level when it declined, and a recovery was likely to develop. A recovery did develop after that buy signal, leading to then a global buy signal last month. Right, so first the tactical buy indicating a low risk level. The global buy tells us there's a potential that the bear market is over and a new bull cycle has begun. So with both the tactical and global buy signals, we moved a portion of the cash off the sidelines back into select investments in the various strategies that we manage. So the market model was quite active in the last year, more so than usual, but we designed it to alert us when we should take proactive action for you, and we believe it did a fine job. When the global buy signal occurred last month, we said that such signals are typically a solid investment time for at least an intermediate term period. But we did point out that there have been a few signals that were what we called false starts, and those tend to occur during long bear cycles, like the one that carried from 2000 all the way into 2002, even 2003 for a period. And then the other that was started in 2007 and carried into 2008. During those previous extended bear cycles, the economy experienced a recession, causing the cycle to extend for longer periods than is typical without a recession. And that leads us to the next model I want to discuss, our recession warning models. We design recession warning models to give us an advance warning of an economic recession. We want a model that warns of pending recessions because, historically, equity bear markets coupled with a recession tend to be drastically worse and more severe. The declines are more extensive and they last a lot longer. So here you could see one of the recession warning models. This is the U.S. Weekly Leading Economic Index. This one had been negative for the last couple of months. And you could see the tendency when the blue line crosses below the black line, it flashes a recession warning. The gray shaded areas are when recessions occurred. So you could see typically there's forward warning for the weekly leading index to move into negative territory, and sometime later a recession occurs. Then we have the U.S. Monthly Leading Economic Index. And this has two indicators built in. One, the blue line is a very long leading economic index recession warning. It tends to move into recession territory well before a recession occurs. The red line is more of an intermediate term leading index, still leading, but less leading than the long leading index. Well, that is what changed in the last month, and that is the red line has now officially gone below zero. You could see when that tends to happen. Recessions tend to develop sometime in the coming months. First, the blue line moves, that's the long leading. Then the red line moves into negative territory. That's the intermediate term leading. Happened back here in the 2001 recession, happened here in the 2008 recession. We have the same type of setup occurring now. So this model gave the latest signal, and a recession will likely develop in the months ahead. With that change in our models, we moved some funds back into cash to reduce risk exposure. The signal from the recession model now calls into question how long the market model will remain on a buy signal. It's increasingly possible that the global buy signal will be a false start in the market model. A second global sell signal could trigger soon, and if so, will determine that the bear market isn't over and another down leg is likely developing. Now, we've demonstrated this chart to you over the last several months, showing that historically corrections in the S&P 500, when they're coupled with recessions, are much more severe than corrections without a recession. So you could see the black diamonds are corrections without a recession, average 15% drop over about 100 business days. Average with the recession is a 36% drop over about 300 business days. So now that a recession is more likely being entrenched into the economy, we have to brace for a longer bear market. Another model we have is our market valuation model, and that's designed to help us understand the very long-term potential in the S&P 500. When the current valuation for equities is high by historical standards, returns tend to be limited over the following 10 or so years. Of course, when the current valuations are low, then future returns have a better chance of being high. So here you could see the latest read in our market valuation model. We're just off of sky-high levels. We were at the highest valuation, according to this model, ever prior to the start of this bear market. So high valuations lead to low forward 10-year returns. That's the shaded part of the chart. Low valuations tend to lead to very high forward 10-year returns. Well, we're just off of an all-time high. So that tells us likely over the long term, there's not a lot of great opportunity in the market. The way that valuations tend to get restored are through substantial bear markets. That occurred in 2000, the last time equity prices were overvalued. And you could see in a 2-year bear market how valuations got restored very quickly. But that was a painful period for stock investors, lasting 2 years plus during that time, and evolved into a 50+% drop in the S&P 500. And then there was a second bear market in 2007 that resulted in the next leg down until valuations got completely restored, and then that set up a very long period of rising stock prices. Well, we're not in that position now. We don't know if this is the ultimate high for this cycle, but there's a good chance that it is, and with an increase in the probabilities of a recession, that sets up the potential for a bigger drop in stock prices to restore value in the coming months and years. So there's a look at the various models we use, how they interplay with each other, and explains the increase in activity in our strategy over the last year or so. We have to remain in sync with these models as they evolve, regardless of the investment activity it requires. Historically, when these models are in tandem in one direction or the other, the tendency is for big market movements to take place. We saw that in 2000 when the recession warning model gave its recession warning. The market model moved to sell signals. The market valuation model was sky high at that time, and that resulted in a big down move. We saw the exact opposite in 2009 when the market model moved to a buy signal. The recession warning model wasn't flashing a recession and didn't for years afterwards. And the market valuation model showed that valuations were low, so we expect high stock prices for the long term. So today, with our recession warning model negative and our market valuation model screaming that stock prices are sky high, if the market model moves back to a sell signal, we will act to move back to the sidelines. We designed our investment management approach to be in alignment with the number one concern of our clients, and that is wealth preservation. So that's a good update on the various models and the current position of our strategy. We'll continue to keep you posted in 2 weeks with our next update, or if anything important develops in the interim with a flash alert. Have a great weekend, and thanks for watching today.